So I would argue that in larger institutional denominations, silver is still available. It was not available through the LBMA for a while because paradoxically, the LBMA silver came to North America so that it could get out from under the Trump tariffs. And then the shortage developed rather than in the United States at the LBMA. And so silver has been going the other way. The longer that we go without a short squeeze in silver, a physical short squeeze, a failure to delivery, the lower the probability that that occurs. The refiners are working 24/7, taking non-good delivery silver, refining it, and turning it into LBMA Comex acceptable product. What is changing, of course, the thing that causes all this to occur is price.
Comex silver delivery intentions show a recent, highly elevated demand for physical metal, with record-breaking delivery volumes even in smaller months. As of early 2026, registered inventory levels are under pressure, with significant volumes, tens of millions of ounces, being moved into vault, indicating a strong trend of participants prioritizing physical possession. PreciousMetals analyzer RickRule underscores the extreme leverage within the COMEX, where the notional value of silver traded every day often exceeds the physical metal available for delivery by 100 times. He warns retail investors that an engineered silver squeeze is unlikely to succeed. If a true failure to deliver occurred, Rule predicts the COMEX would simply declare force majeure, shut down the market, and force a cash settlement at a price they determine. Concurrently, Rick challenges the social media narrative that China is banning silver exports because it's a strategic asset. Instead, he mentions that China has simply limited export licenses to 40 cronies, effectively turning silver exports into a political favor rather than a strategic embargo. For investors looking at mining stocks, Rule is candid about the risks and rewards of Latin America. Despite the recent 45% crash in Vizsla silver following local violence, Rick says he is staying invested. He predicts that the silver in the ground will outlast the current wave of social chaos, though he cautions that this strategy requires a very thick skin that many retail investors may not have. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Rick Rule's recent interview.
Well, it points out the leveraged nature of COMEX, where many days, 100 times the notional value of silver available for good delivery trades every day. This is a hugely leveraged market. But I think it's important for the retail investors who believe that a silver squeeze could be engineered to understand the nature of those contracts, understand the nature of Comex. Comex is an exchange owned by the dealers. They set the rules. What would happen if there was an actual failure to deliver would be that the COMEX would declare force majeure, they would shut down the market, and they would cash settle at a price that they set. You will never, ever catch the dealers short in a market that they own. So people need to understand that. Now, that cash settlement price might be very painful for them. It might be pleasant for speculators. But the idea that there would be a buy-in, the idea that the dealers would treat themselves the same way they trade their customers, is wrong. That will never, ever occur. I need to say, too, that there were structural imbalances in the silver market, meaning that the silver price went up too fast for the inventories of good delivery in-system silver to keep pace. The refiners couldn't keep pace. The further we go without a physical squeeze, the more non-good delivery silver can be processed by the refiners and can become good delivery. A second issue, popular in social media, has been that the Chinese have constrained exports, that the Chinese regard silver as a strategic asset, particularly around their solar industry. That's not strictly speaking true. The Chinese allowed their own citizenry to save in silver, but now they've decided to tax their same citizenry on that silver, sort of countervailing measures. But importantly, what they said was that they would prohibit the export of unauthorized silver, that only authorized dealers could export it. What that meant is that they passed out political favors to 40 of their cronies. They didn't constrain. They constrained. They didn't obviate the export of silver. They just made sure it was their friends who made the money, not everybody else. And finally, what I know parenthetically is that while there is a shortage of good delivery, investment grade silver in retail denominations, thus far there hasn't been a shortage of wholesale availability. My former employer, Sprott Inc., through the Sprott Physical Silver Trust, has been experiencing inflows of capital. And by its articles of incorporation, it can't accept deposit receipts. It has to have good delivery physical silver. And thus far, they have been able to buy that silver. So I would argue that in larger institutional denominations, silver is still available. It was not available through the LBMA for a while because paradoxically, the LBMA silver came to North America so that it could get out from under the Trump tariffs. And then the shortage developed rather than in the United States at the LBMA. And so silver has been going the other way. The longer that we go without a short squeeze in silver, a physical short squeeze, a failure to delivery, the lower the probability that that occurs. The refiners are working 24/7, taking non-good delivery silver, refining it, and turning it into LBMA Comex acceptable product. What is changing, of course, the thing that causes all this to occur is price. I remember when a person running for president in Mexico, Mr. Colosio, was shot and killed in Tijuana. And this was many years ago, that resulted in the Bolsa, the Mexican Stock Exchange, selling off by about 45%. I hate to be cynical, but within 6 months, the Bolsa had resumed its prior levels. What one needs to do if one's going to invest in Mexico is have a very, very thick skin about sociology and violence. And one needs to buy the sell-offs, buy the news. The second thing is that if you are an investor in silver and you aren't invested in Mexico and Peru, you aren't an investor in silver. You're a spectator. Yes, silver occurs in other parts of the world, notably Russia, Poland, some in the United States, some in Canada. But if you are going to access true tier one deposits, deposits that inhabit the lowest cost quartile and the highest return on capital employed quartile, they're going to be in Mexico and Peru. It's as simple as that. These problems, the problems with regards to cartel violence in Mexico, I think are going to accelerate, particularly in Sinaloa, where the incident that you described occurred. The problem is compounded because there's a war between two factions of the same cartel for control of Sinaloa. Wars require money. One place to obtain money, particularly given stronger U.S. border controls, is to shake down the mining industry. A separate issue is the Mexican government serious about confronting the cartels? And if so, do they have the tools? You may or may not remember, Tim, and your viewers may or may not, but 30 years ago, the Mexican government formed an elite anti-cartel task force. And after about 18 months, the elite anti-cartel task force transformed themselves into a cartel. I think that's indicative of the challenges. I, by the way, have stayed invested in Vizsla Silver. The events are not events I forecast, and by the time I woke up to it, the stock price was off 45%. This is, in my mind, the third best undeveloped silver deposit on the planet. My speculation is that the silver will stay in place long after the violence has subsided, and that Vizsla will continue to control that deposit. It's worth noting, I could be wrong. It's also worth noting that after 73 years on Earth, I have the psychological and the financial wherewithal to take that risk. Other people may not.
In his analysis, RickRule warns that investors holding large amounts of cash could face significant losses in real purchasing power. He predicts that over the next decade, major fiat currencies such as the US dollar and the euro could lose as much as 75% of their purchasing power due to ongoing inflation and monetary expansion. While being long-term bullish, he highlights that investors should not necessarily expect the same rapid price escalation witnessed during the 2024 to 2025 surge. When equity portfolios are generating large losses and margin calls are being triggered, gold is the most liquid, most universally accepted collateral that can be sold rapidly to raise cash. In his contrarian point, Rick dismisses the popular 15-to-1 or 50-to-1 gold-to-silver ratio as a factoid primarily used to generate commissions and sell newsletters. He mentions that since most silver is a byproduct of copper, lead, and zinc mining, investors should watch the production schedules of those industrial metals rather than arbitrary ratios to understand silver's true supply. Let's jump into the interview.
I think the ratio is a factoid. I think that prices go to supply and demand, first of all, and they go to utility. The ratio of silver to gold in the Earth's crust has nothing in the near term to do with supply, and it has nothing to do with utility. So while I think that 15 to 1 is useful for generating fees and commissions and also for selling newsletters, I don't think it has much real world implication. It's important to remember that most silver that's produced isn't produced by silver mines. It's produced by copper mines, lead mines, and zinc mines. And if you want to understand something about silver prices, rather than focusing on the relative abundance or scarcity in the Earth's crust, you have to look at production schedules of copper, lead, zinc, and laterally gold. Two, with the changing utilities of silver, which is to say its growing industrial applications and its relative decline to gold as a monetary metal, you need to take utility into consideration as well as supply. What people want is they want a one-size-fits-all ratio, a factoid, something like 15 to 1, to justify an action that would rationally require hard work and long calculation. So as I say, in the 50 years I've been in the business, that 16 to 1 ratio has been great for generating commissions and selling newsletters. It has had very, very, very little impact on rational analysis of the silver price. My 10-year outlook is that gold will maintain its purchasing power, absolute purchasing power. And fiat currencies like the US dollar and the euro will lose 75% of their purchasing power. The consequence of that is that I save in gold rather than euros or dollars. So I'm long-term bullish on the gold price. I don't think that we're going to have the same rate of escalation that we enjoyed in 2024, 2025, but I'm bullish about the gold price. The consequence of that is that as an investor, I am comfortable with the Francos and the Wheatons and the Agnicos of the world. I also believe that and I believe them to be effectively at the corporate level riskless. I think the gold price goes higher, and I think they have high quality operations. I think that they will be able to deliver. And so they are investment quality, set and forget investments. You will see better opportunities, but opportunities with more risk further down the scale. I can invest, not that's the wrong phrase. I can speculate in the junior because I've done it for 50 years. I know how to do it. I know how to assess the management teams, and I'm willing to do the work. I'm willing to take the risk. Most of your listeners, Tim, I suspect, would be better off playing the beta game, buying the biggest and the best of the best, and just letting the increase in the gold price in their domestic currency give them the gains that they would hope for. If you have listeners who are willing to do the work, who are willing specifically to spend at least an hour a month on each of their individual holdings, not listening to podcasts like this, but rather reading quarterly reports, reading proxy statements, reading insider filings, there is more money to be made in the juniors, but there is more risk and more work than the average would-be speculator is willing to do. So they need to answer that question for themselves as to where the value is. The big guys will, because of their size, their efficiency, and their trading liquidity, have higher share prices and hence a lower cost of capital. The tier immediately below that will have a higher cost of capital, which is to say a lower share price. And over 5 years or 6 years, that will either be arbitraged away by people like me, or the big guys will take over the little guys. That's what happens. Markets equalize. The single asset producers are viewed by the market correctly as riskier than the multi-asset producers, because if something goes wrong with their one asset, it cripples them. That discount goes away when they get taken over. By definition, a multi-asset producer that takes over a single asset producer erases the single asset producer discount. So there are arbitrage opportunities in that market. There will be horizontal amalgamations too, not a case where a big guy takes over a little guy, but a case where two or more little guys merge to create a big guy. There will be opportunities for producers to take over developers because they have a lower cost of capital and they have more expertise at developers. And in the exploration sector, because high quality discoveries, say a snowline, are so rare that they will be taken over for eye-popping multiples. But in order to play that game, you have to take real risk and you have to work very hard. For most people, foregoing some of the gain and eliminating the risk and the requirement to work is a good trade. Most people should be involved in gold, Franco, Wheaton, and Agnico. Stop. Only those who are willing to do the work. They may self-select by listening to programs like yours. Only people willing to do the work should allow themselves to come down the quality trail. in hopes of securing alpha as opposed merely to securing beta.
While short-term fluctuations are possible, silver's long-term outlook is supported by strong industrial demand, supply constraints, and continued investor interest in tangible assets. Factors such as renewable energy growth, inflation, and economic uncertainty could contribute to higher silver prices. When silver outperforms gold this aggressively, it signals that the market is not just buying safe haven assets. It is buying commodity exposure broadly, betting on economic activity continuing rather than collapsing. Could rising physical demand and weakening fiat currencies eventually trigger a major revaluation of silver and gold in the global financial system? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.